Awesome. Huge thanks to Gordon for talking about the importance of stablecoins with Circle. We're going to continue the conversation about stablecoins with this next talk titled, Does Tether Cause Systematic Risk for DeFi Ecosystems? This talk is going to be hosted by Phil from Cork Protocol. Please welcome our speakers.
Hello, everyone. Before we jump into the topic, it'd be great to introduce our great panelists, Luca and Sonya, if you guys want to quickly introduce yourselves.
Hi, everyone. I'm Luca. I am the founder of a stablecoin decentralized infrastructure project called M0. I've been researching, writing, and building stablecoins for quite a few years. So thanks for having me.
Hey everyone, I'm Sonya, chef at Steakhouse Financial. We are bridging DeFi with TradFi. We're crypto-native consultants to some of the largest DAOs, including MakerDAO and LidoDAO. We're also risk curators on a lending platform called Morpho, and we've been delivering yield to stablecoins, including USDC and USDT depositors.
And I'm Phil. I'm one of the co-founders of Cork Protocol. We are tokenizing risk and building ways for people to price, hedge, and trade the risk of depegs on stablecoins, liquid staking, and restaking tokens. So as long as you're not a regulator, you can think about it conceptually as a credit default swap-like product for pegged assets. So let's dive in. Tether is by far the largest stablecoin with over 70% market share. It's 2.5 times larger than Circle, its next competitor, and everyone else is sort of, making up just a very little tranche of that. And yet, Tether doesn't do public audits. There's been, for years, FUD. There have been books written about it. There's been, lots of journalists have gone down the rabbit hole of trying to prove that Tether was not fully backed, yet it never really got there. And so the ecosystem has sort of accepted that Tether is safe. And I guess the overarching question is that true?
OK. Should I take this first?
You
Sure.
go first.
I have not obvious take on this. So I think the interesting, the panel, the title of the panel is Tether, does Tether constitute systemic risk for crypto? Yes. We have 21 more minutes to spend on this, but yes. But I don't think it's for the reasons everybody thinks about. Interestingly enough, lack of transparency, if you look in research, lack of transparency is one of the key characteristics of money market instruments. Nobody knows what is the risk that banks actually have on their balance sheets, not even the board members of those banks. I sat on the board of ECB-regulated banks. Nobody knows. Nobody cares. I think that, so lack of transparency is not necessarily a bad thing. Interestingly enough, and there are people in the audience who remember this very well, when SVB went down, Circle depegged exactly because everybody knew the risks that USDC had. So excessive transparency is very bad for money market instruments. So I think Tether is big. Is it safe? The question is it enough reserved or not? I think this is not the right question. I think the right question is the equity buffer Tether has big enough to absorb the unknown unknowns that are in those balance sheets? In my opinion, no. But the best way to do it is actually grow other ecosystems that are developing stablecoins alongside Tether instead of converging entirely on one issuer.
I think Tether's had an interesting journey. If we're talking about Tether in 2025, it paints a very different picture to Tether in 2017. Even though they don't do full audits, they do report these attestation reports. If you look at the composition of the reserves right now, it's over 80% cash and cash equivalents. The problematic high credit risk corporate bonds that were kind of talked about very widely are now less than 0.01% of the reserves. So I think the credit profile or some of the risks that we were wary of back a few years have diminished. And now, thanks to a vibrant risk-free rate environment, they are one of the most profitable financial institutions in the world. They've made $13 billion in net profit last year, drawing $10 billion in dividends. So from a well-capitalization perspective, I think Tether looks quite good today. Of course, risk exists where you don't think there's risk. So Tether's, to my mind, been stress tested and has been the focus of many people's nervousness. So ironically, perhaps there's less risk than what we've been worried about in the past.
At this point, what would actually cause a Tether depeg? What scenarios can you paint that would actually land us there?
So I agree on the ability of Tether. That Tether has demonstrated to churn their balance sheet and improve the quality. Whether there is enough capital, I mean, I used to be a financial institutions analyst, so if I look at that balance sheet through a Basel III framework, I would probably put a couple of $1 billion on top of it, but for Tether, it's like 40 days of operations, so it's a good position to be. In my opinion, actually the highest risk, interestingly enough for that, is Bitcoin. Bitcoin currently represents a very significant portion of Tether's balance sheets, and Bitcoin is a very volatile asset. But at the same time, I think that trust of the ecosystem on an issuer is very important for digital money, and I think the crypto system trusts that Tether is going to stick around for long enough to go through a bear market in Bitcoins. I think the fact that Tether hasn't been bending the knee to regulators that were trying to protect the financial sector and the banking sector has put them in a great position vis-a-vis competitors to be considered one of the core assets of crypto. So my opinion is Bitcoin is the major short-term risk for Tether, and we have seen the volatility in Bitcoin market now. But trust is the most important thing that you have when you're a currency builder, and Tether, surprisingly, has more trust than Circle in crypto, because we know that they are here to challenge the financial sector, and probably Circle is not. So, and I have a lot of respect for Circle as well, but that's the truth.
I agree that Bitcoin is a risk. Perhaps it is a bit overplayed. So last time I checked their balance sheet, they had around $7 billion in equities. So Tether is actually on a consolidated basis over-collateralized. They also have around $7 billion in Bitcoin. So there is some buffer there, which should help. I think beyond that, I would have said regulatory risk. Of course, Tether runs an extensive ex-US operation and is one of the larger holders of US treasuries. It feels like under the Trump administration and Tether's relationship with Cantor Fitzgerald, the fact that the former CEO, Howard Lutnick, is now the US Secretary of Commerce under Trump, establishes an indirect link into Washington. So that's positive, but I fear that maybe the U.S. competitors will do everything possible to try and run a smear campaign against Tether or play regulatory capture to their advantage at the expense of Tether's.
Yeah, I mean, the regulatory issue is actually, I think, probably the most prevalent right now. Tether has effectively been outlawed in Europe under MiCA. The 2 stablecoin bills that are currently going through the U.S. Tether would follow a similar pattern there, where it would be outlawed. Is that going to be do you think that if that does happen in the U.S., does Tether's market share stay the same, go up, or go down?
I think it is structural that Tether's market share will go down significantly, stablecoins, simply because the use cases of stablecoins is changing. So Tether was the best player for the early days of crypto, where main use cases were trading or lever trading. So currently, Tether represents, I don't know, like 70% of the market share. I think it is becoming clear that stablecoins are becoming the best substitute for bank deposits in the future. In my opinion, the stablecoin revolution is the most relevant financial revolution we will see in our lifetimes. And Tether is not the best player to take the core, to be the most relevant for the next stage. So I think Tether will continue to dominate its sector, which is offshore dollar movements, will grow, will continue to be very profitable. But if we expect stablecoin market to grow 10 to 50x in the next 20 years, which I do, Tether probably will represent 5 to 10% of that market, not 70.
Yeah, I completely agree with Luca. To my mind, Tether is a bet on the adoption of digital dollar in emerging markets. Of course, with the recent announcement from the CEO of Bank of America saying that they might release a stable coin once regulation is sorted, this suggests that there'll be a lot more players, regulated financial institutions, looking to launch a stablecoin. So the relative growth between EM use of digital dollar, i.e. Tether, and the growth of the stablecoin ecosystem in the US, that's kind of where the Tether's market share is set to diminish, I think.
As we zoom out, take sort of that end state scenario where Tether's market share is shrinking and there are lots of new entrants into this market, how do you guys think about the difference between centralized stablecoins and decentralized stablecoins as part of that market adoption?
So we live in a decentralized money world. We have commercial banks issuing M1 money. They're all different. We treat them the same, but because there is a central bank at the center that is providing this type of money uniqueness. But we live in a decentralized money world. And we will continue to live in a decentralized money world. I don't believe that this future will be dominated by 2-3 massive centralized issuers. We will have networks that enforce similar standards and connect liquidity and use cases for many issuers to pledge collateral and issue digital money. I come from the maker ecosystem. I joined the maker ecosystem because for me it was a revolutionary view of the way we do money issuance. I absolutely do not believe in a future with Bank of America issuing their stablecoins. And I hope we don't live in that future. I think builders here in this room should build stablecoins on decentralized stack. And so that's my view. I think by decentralized stablecoins in the first iterations were considered crypto asset-backed stables. I think we will have real world or treasury asset-backed stables that are issued on software through networks where the builders who build use cases get most of the upside. The banks will try to protect their monopoly on deposits. They will fail because they don't work well. So that is my opinion. I think we will have a long list of mini issuers coming out now, but I think those issuers will kind of congregate within some sort of network that aggregates liquidity and use cases. Liquidity is the most underappreciated aspect of stablecoins. You can have the best stable in the world, but if you don't have a liquidity network, it's useless, and building a liquidity network is costly.
Yeah, I completely agree, and I think there's two big things that we don't talk about. New stablecoins coming out, even if Bank of America does launch a stablecoin, they have to build a liquidity network next to it, which obviously Bank of America has the resources and the capital to do, but other stablecoin builders who are trying to create novel designs or new systems, it's very expensive and very difficult for them to do that. How do you think about ways that they can actually build that? And also, how does you think about the risk in the market of that, different amounts of liquidity as well as different designs?
I think you have to optimize your stablecoin for certain usage and be able to stand out. So in the case of decentralized stablecoins, I think one of the big advantages would be yield. We know that on-chain sources of yield tend to be higher, and with RWAs also coming on chain. We're transporting real life, say treasury yields on chain. So on chain yield environment looks way more diverse and of course higher because of the speculators, driving up yield at different moments of the cycle. So if you construct a stablecoin that can draw from these sources of yield, which, for instance, Sky's SUSDS is doing, then you can really separate yourself from the competition through this yield feature, which stands out. So I'm excited for different experimentation and products that try to really optimize on a certain characteristic that tries to not just rely on liquidity, but different features that stand out.
As you start seeing stablecoins now competing on yield, because that is the use case for some of these new stablecoins, do you not start seeing them moving up the risk spectrum and taking on more risk that they then are passing on to a lot of users who don't necessarily understand how they're constructed or what the actual risk factors are?
Yeah. I also don't think these are... I mean, I'm a nerd, so the way I define stable coins are deep in the money fixed income instruments. SUSDS is not. SUSDS is a wrapped basis trade hedge fund tokenized strategy. Very different. I think yield is one aspect. I think, in my opinion, stable coins should have the best, the closest to risk-free yield possible, but real users do not care much about the yield, in my opinion. You need to give them a lot of yield. That's why we keep money in current accounts. We don't have any money. We don't get any yield from that, little. So I think that I agree with Sonya, but I think we will go in the direction where hopefully crypto brings utility to people. So builders will build applications for people that need dollars and embed dollars into their application stack. And they will connect in the back end with rails on-chain that allow them to move money around and invest it in strategies or do different things. So that's where I think the future is going. Really the mullet, like fintech with DeFi in the back. And Morpho, for example, the guys at Morpho have been great working with Coinbase on this. The reason why I think this is also connected to the reason why I think the Bank of America's, the JP Morgans of this world will not be successful, because they will obsess with control. And we don't want control. We want to have like an open source financial system where we're building better and better primitives on chain that facilitate liquidity, yield aggregation, reduces cost. And we don't want to buy into the JP Morgan stack. And I think this is antithetical to the way financial institutions have grown in the last 50 years.
Yeah, I completely agree with that. And I think that's sort of the real use case is about builders building applications that solve real-world problems and abstracting away all of the backend and the primitives that are here, right? If I'm going to do something in an application, I don't actually care or necessarily even want to know what stablecoin is being used to process my payment or do it. The challenge that I think exists now is that in most of the world, if someone is building an application to do that and they're going to abstract it away, Tether is the first choice use case. They just use it, it's easy, it has liquidity, and it has ubiquitousness across the ecosystem. How does that change, and how do you convince builders to use something that's different and better and ultimately has the ability other than yield?
Yeah. I think I just want to, and then I'll let the others answer as well, but I think I just want to double down on what I said before on the yield. I think the ultimate user doesn't care about the yield, but the intermediary does care about the yield. So if you are a user, we have seen like the lack of traction of yield-bearing stablecoins. But so imagine you have an application where you have 1 million clients and each client has $1,000. The $1,000 client doesn't care about the yield, but you care about like the $1 billion that is sitting on your app. So imagine if you are an app developer and you can actually provide a dollar use case for your clients. They don't know what's stablecoin. They just see a dollar balance on the app. And you can have the same liquidity as Tether, the same off and on ramps, but you make $50 million of treasury yield for your company. And you run the operations with this. So I think the yield is a great source of market capture for developers and applications. And we are trying to build liquidity networks and tools to allow this, so that the complexity of on and off ramping liquidity, the need of network is abstracted away from the application builders.
So the question was, other than yield, how do you differentiate yourself?
Or how do you
overtake Tether?
How do you get the builders to, yes, the builders will want yield, right? And that's one way to get them into that ecosystem. But right now, it's so much easier to build and bootstrap. How do you get them to pick one stablecoin over another? How do you get them? Because the yield use case right now, anyone could be doing this with any of the yield-bearing stablecoins today. Most people that you see out there building real-world use cases outside of Europe and the United States, right, where they're building this for the developing world, where they're onboarding tens of millions of people into crypto, they're using Tether. That's the primary use case. How do you get them away from that? How do you get them off this addiction to Tether?
I don't have a good answer for you. The fact that it's the most liquid means there's least amount of drag when you're going from a token to USDT. So, liquidity begets liquidity. It gets more and more difficult. And I guess all this is to say I'm quite bullish Tether after this discussion.
Yeah, I mean, you need a lot of work and a lot of money. Now, there is a lot of money out there who can do that. The way we see it at M0 is we are horrible marketers. This will change, but we want to provide application builders with absolute total control about their tech stack, the way they distribute the yield, the liquidity they have, the smart contracts, only with code, no paper, no compliance, super easy. And we will bring a lot of money who can help them doing this. So it's also like the experience and the simplicity of embedding your stable infrastructure in your app. So you can focus on the app layer. It's not easy, but I'm absolutely not here to say, okay, Tether is too big, so we're gonna leave the global financial systems to 25 guys.
What do you think, Phil?
I think it is. I think a lot of what Luca said is right. It's making the builders have an easier experience and a better experience. That's got to be the answer. But I also actually think it's marketing, right? Tether has had such a head start that their brand is ubiquitous. You go anywhere around the world, and most people know Bitcoin and Tether, right? And that's, and you can do things with Tether that you can't do with anything else, right? On and off ramps. Not even Bitcoin has that level of on and off ramps around the world, where you can just walk into some place, send someone 100 Tether, and they give you $100 in local currency. So I think it's about how do you get those on and off ramps to get that level. And maybe it is integrating with some of the existing use cases in the current financial system that allow for those rails to be used. And I think that's a little bit what Circle's play is. But I think it'll be interesting to see how this all plays out. I think it'll be interesting once we have risk pricing tools to let actually the market dictate the price of risk across all the different basket of stablecoins and pointing to ones that are much safer than others. I think that'll be really cool. And I also think it'll be really interesting to see if Tether ever actually does an audit.
Or passes on the interest margin to any of the integrators or users.
Yeah. Any last thoughts?
No, I think you should spend 30 seconds telling the audience what you are doing, guys, at Quark to do this.
Sure. So at Quark, we're building these risk pricing tools for the market where you can actually go and create what we call a DPEG swap. And the DPEG swap allows you to, on a fully collateralized basis, trade one stablecoin or one LRT for another one. And so if your stablecoin DPEGs, you actually have insurance against it. And because that's a liquid trading instrument, the market can price and trade both sides of that trade to allow you for the market to give you a price signal as well as for people to be able to buy a hedge. Everyone should check it out, quark.tech.
Thanks.
Thanks, Luca. Thanks, Sonya.
Thanks.
Thanks, everyone.
She winks at the moon.